Dear friends, welcome back to Shasha's virtual classroom. So today we will discuss practice questions from chapter 1, Catherine Cocom. So these are the questions. So what I advise you, so before starting to look at the answers, please try working out the questions on your own so that you can cross check with the answers later on. So it will be like your concept will be clear. So first question. Which statements about bookkeeping and accounting are correct? Okay, so which statements about bookkeeping and accounting are correct? So first you try on your own, then you can cross check. Okay, accounting is dependent on the accuracy of the bookkeeping records. As we already discussed, accounting is dependent on the accuracy of bookkeeping records. Correct, because bookkeeping is primary aspect. Bookkeeping is primary aspect. So after bookkeeping is done, if the bookkeeping is correct, then accounting is based on this. So this is correct. So accounting takes place periodically rather than each day. Normally it will take place like after every 6 months or 9 months or 1 year. So this is also correct. So bookkeeping includes recording financial transaction. Obviously it includes only recording financial transactions, not other than financial transactions, they are not recorded at all. So bookkeeping includes the preparation of statement of financial position. No, that is the job of accountant. So it is not the job of bookkeeper. So 1, 2 and 3. This is the correct answer. So next, which of the following best describes a statement of financial position? A calculation of the total amount owed to the owner of the business. Okay, this is also correct. A calculation of total amount owed to owner of a business is correct. A list of assets, liabilities and capital of a business on a certain date. This is also correct. A list of everything owned and owed to a business. This is also correct. A summary of money paid to and received by a business. This is wrong. So which one of the following? Which one of the following? So any one. So it is a list. A list of assets, liabilities and capital of a business on a certain date. So this is the best answer. List of everything owned by and owed to a business. Owed to a business. Not only owed to a business, it includes owed to a business also. This is correct. See, very careful, you have to be very careful. Okay, so a calculation of total amount owed to the owner of the business. So it does not show any calculation, just it shows so a list of assets, liabilities and capital of a business on a certain. This is more appropriate. A list of everything owned by and owed to a business. No, everything owed also is given. No, so owed, it is owed by, not to. So to be careful here, owed to. Okay, it is owed by a business also. If that was there, then it was correct. A summary of money paid to and received. No, this is wrong. So this is the most appropriate answer. Okay, so next. A business has 6,250 in its bank account. The following transactions took place. Obtain a 3-year loan which was paid directly into the bank. Okay. So purchased office equipment and paid by check 2,000. Sold goods on credit 1,050. How much was there in the bank after these transactions? So basically you need to calculate the bank balance. So it had 6,250 in its bank account. It already has 6,250. 6,250 is already there. So obtained a loan which was paid directly into the bank. So it will add up 5,000. It will increase. Bank balance will increase. Purchased office equipment and paid by check. So you are making the payment. Money is going out. So sold goods on credit. This has nothing to do with You are neither receiving cash nor paying cash, nor you're receiving check nor you're paying check. So that's all. So this net amount. So what is the net amount? 6 plus 3 is 9,250. So 9,250. So 9,250. This is the correct answer. So this is how you have to carefully. Okay, so this is a calculation of bank balance. What is required? How much was there in bank after this transaction? 9,250. This is the answer. Next. A trader provided the following information: property 88,000, inventory 19,300, trade payables 25,250, trade receivables 27,420, fixtures and fittings 31,300, loan from bank 60,000, cash at bank 3,170, motor vehicle 18,360. Calculate the value of the assets. So what are the assets? So this is an asset, this is an asset, trade receivables also is an asset, furniture and fixings is also asset, cash at bank is also an asset, motor vehicle also is an asset. So property is something we have, inventory is also something we have, trade receivable is something which is owed to us, which is owed to us, that is business. So always you have to see from business point of view. Okay, so owed to us. So fixtures and fittings 31,300, cash at bank 3,170, motor vehicle. So you have to add all this. So 88,000 plus 19,300. Let us just check. 88,000 plus 19,300 plus 27,420 plus 31,300 plus 3,170 plus 18,360 187,550 187,550 187,550. This is the answer. Calculate the value of the liabilities. Liability is something which we pay to the outsiders, which we have to pay to the outsiders. Okay, so this is one, this is the other. So only two things are left. So 25,250 plus 60,000. So 85,250. 85,250. So this is liability. This is liability. This is something we have to pay back. Loan from bank is something we have to pay back. This is what we are owing to the outsiders. We have to pay back this. Calculate the trader's capital using the accounting equation. So this minus this, simple. That's also assets is equal to assets. So we have to subtract this from this. So we get accounting equation. So how do you calculate? Assets is equal to liabilities, assets. So capital is equal to assets minus liabilities. So this is the accounting equation, right? So what is the other way we write? Assets is equal to liabilities plus capital. Assets is equal to liabilities plus capital. So how do we calculate? So 187,550 minus 85,250. So 102,300. 102,300. This is the trader's capital. So this is the end of question 4. Okay, so practice question 4. So now let us see question 5. So what does it say? Copy the following table and complete it. Show the effect of each of the following transactions. The first one has been completed as an example. So bought a motor vehicle and paid by check. So what is happening? Effect on liabilities, you have to write effect on assets and effect on liabilities. Okay, so bought a motor vehicle and paid by check. What is happening? Motor vehicle is coming in, so motor vehicle is increasing, and the bank balance is decreasing because money is going out. So next one, paid a credit supplier from the business bank account. So what is happening here? So supplier is a liability. Liability is coming down, and bank account is also coming down. So there is decrease in bank balance, and there is decrease in creditor also, supplier. So what is happening? Bank balance is decreasing. So what is happening to affect credit supplier? Credit supplier is decreasing. So asset is also decreasing, liability is also decreasing. So next, C, received a check from a credit customer. So what is happening here? Money is coming from a credit customer. So there was money that was receivable from a person, and the money is coming in. So what is happening? Bank balance is increasing. Obviously money is coming in, bank balance is increasing. So but credit customer, credit customer, what he is doing? He is giving us. Credit customer is paying us. So this will decrease. Credit customer will decrease because he has paid the money. So it will decrease. No more, the money is no more receivable from this guy to that extent. Received a check from credit customer. Sold goods at cost price and received a check. Okay, so what is happening here? What is happening here? Bank balance is increasing. Bank is increasing, bank balance is increasing. Why? Because we are selling. Okay, received a check from sold goods at cost price and received a check. So effect on liabilities, there is no effect on liabilities because it is sold at cost price and received a check. So inventory is also an asset, so inventory is also coming down. Inventory is decreasing. Why? Because when we sell, the goods go out, the merchandise will go out of the business.